Gold recovers an entire month's worth of losses in a single week. Stocks are mixed as bonds bounce from decade lows and the dollar falls. Here is your New Sky Bay end of week markets debrief. So the very, very sober, very tragic news that's been dominating the news cycle, both financial and non-financial this week, is of course the horrifying events that have been unfolding in the Middle East since last Saturday. And the how and the why is far beyond the scope of this channel. Please go to other parts of YouTube if that's really what you're interested in. This is very much an economics, finance, markets focused channel, so I will be approaching this through that lens. And of course, what we have is, to speak in officials' terms, what we have is something called geopolitical instability, right? You have, alongside humanitarian issues, you have a geopolitical instability situation. Right now, the situation is very much focused and isolated between Gaza and Israel, but events potentially, if other parties and other countries in the region get involved, it could spill out into a broader war, which would be, again, horrifying on the humanitarian front, but creates very, very severe reaction to the economic and ergo the market outlook for the region and the globe. So the situation right now is isolated and markets have had a bit of a muted reaction, but we did see an enormous spike in gold, and oil had a bit of a bounce too. So to speak to the former, you can consider gold to be a big red panic button that investors hit whenever there's a situation that could lead to things metaphorically falling apart. Investors think, okay, well, gold has been around for millennia. Gold holds its value and has been considered a status symbol and a symbol of wealth for millennia. And so if, say, for example, the world blows up and I own gold, the chances are I'll be able to trade that gold, right? It's just seen as this massive panic asset, or safe haven asset is what the proper term for it is. And to a lesser extent, so is the same of US government bonds. So whenever the world is getting involved in a war, whenever the world is sort of destabilizing, investors usually look to the US government and think, okay, the US government's probably still going to be around at the end of this, so I'm going to put my money with them. So they buy US treasuries. And so that's what we saw this week at the beginning. So market open, obviously treasuries weren't trading on Monday due to Columbus Day holiday. So by the time US markets opened on Tuesday, we had this enormous spike in the price of bonds as buyers were putting their money with the US government, basically buying up US government debt in the face of this geopolitical instability. We also saw the price of gold pile up. The dollar had a slight increase in the morning based on the back of people buying these US treasuries and people putting their money in America as sort of a safe bank if the world does go to war, right? So hopefully it doesn't come to that, but just to explain the market reaction to you if you are new to markets and investing and trading, geopolitical instability is basically, boom, gold goes up, oil's at risk because of supply disruptions due to a war in the Middle East. The price of oil goes up, at least in theory, in investors' eyes. And US treasuries are seen as the safe haven. So people put their money with US treasuries, so bonds. People put their money in gold. The price of oil shoots up on supply risk. And then all of that usually entails a little bit of a bump in the US dollar because people are buying their money, buying US bonds, buying gold in US dollars. So a bit of a demand goes up. So that's just to explain the beginning of the week to you. Okay? That geopolitical instability is, of course, absolutely horrifying on an ethical level. It's absolutely horrifying on a humanitarian level, but it also poses risks to markets and economics as well as the geopolitical situation. Okay? So that's just to explain that whole thing to you. That's what we saw at the beginning of the week. And as the situation unfolded later on, you saw more of a reaction, specifically from gold. Like gold this week went on an absolute tear, which I'll get to later on. But you have to understand why. There wasn't a technical level that was hit. There wasn't a mad economic reason we saw. It was just mainly this geopolitical instability where investors think, okay, if war breaks out in the Middle East and say America has to get involved and World War III starts, I'm going to own some gold. And that's probably going to be worth something if we all survive it. To laugh at the morbidity of it. So that's that whole situation, and that developed throughout the week, as I'll show you when we get to the charts later on in this video. What we also had this week was an enormous amount of Fedspeak. And this is speakers from the Federal Reserve. And of course they have to use official language, so they can't really walk on stage and say, I think this. It has to be wrapped and laced up in this sort of official language. So people have to kind of decipher it through, okay, what do they really mean by this? And earlier in the week, we had some pretty dovish signals from Fed speakers that indicated that they didn't see a need for another rate hike later on, due to the fact that Treasury bond yields had been soaring this week, or the last few weeks I should say, which contributes to tight monetary conditions, or tight financial conditions I should say. Alright, so these speakers we had on Monday and Tuesday, they hit a very, very dovish tone within the markets, because they were saying, okay, we might not need to do any more rate hikes. This could be the end of the rate hike cycle. And it had a very noticeable effect. The dollar fell, the price of bonds climbed on the back of this Fed dovishness from a certain amount of speakers. And we also saw stocks get a little bit optimistic about this. They said, hey, hang on, what? What did you just say? The Fed's done hiking? Is that literally what you just said? So we saw stocks, go up at the beginning of the week on the hopes of this Fed dovishness. For the first time, we're starting to see it come in really in those terms where Fed speakers are really saying, I think we're done with rate hikes. Okay? So that's what we had at the beginning of the week that wasn't on, in terms of data. These are sort of analogous things that happened in the world of finance that really influenced markets. You had the situation in the Middle East, and you had this Fed dovishness coming from multiple speakers at the beginning of the week. Then what we had on Wednesday, we had the first inflation reading from America with the PPI reading. So that's the producer price index, that's supply side inflation in the macroeconomy. And it came in hotter than expected. Okay, so we were expecting a nice drop off in the PPI figures, but in fact it came in hotter than expected and quite sticky. So that spooked markets a little bit. After the PPI data, we had the Fed minutes released from the September meeting. So the meeting we had 3 weeks ago, the minutes were released. So these were notes made by people who sat down at the meetings, and they took notes about what was being said. So this includes data like the staff outlook. So this is the economists of the Fed putting their projections down, You also have notes made on what market FOMC participants were saying at the meeting, right? So this is key to get an insight into what the Fed was thinking at its last meeting. And I'm going to take a little paragraph from these minutes and put it up on the screen for you now. And the first sentence is basically the bottom line. The Fed is signaling, as it did through the SEPs of that meeting, as it did in multiple speeches afterwards, and as it did in these minutes. The Fed is saying, we see one more rate hike in this cycle. We see one more rate hike in this cycle. It couldn't be more clear. We are seeing one more rate hike in this cycle. Okay? But for the first time, we're also seeing more dovish language come into these minutes, come into these Fed speeches, come into the Fed outlook for rates. On the fringes, it's still dominantly hawkish. It's still, again, that 50 BPS hike in the SEPs we had in that meeting. Watch my video on it if you haven't already. The Fed is still dominantly hawkish in its position, but we're seeing this dovish balance start to come in from the side, with these minutes saying we need to proceed carefully from here. We don't want to overdo it. And then of course the speakers we had earlier this week where they were saying, okay, we might not actually need to hike because the bond market's been doing so much financial tightening for us. There's been all of this language starting to seep into the Fed signaling. And here's just the latest example of that with the minutes. To proceed carefully, and policy decisions at every meeting would continue to be based on the totality of incoming information, i.e. they are data dependent, but they're starting to get a bit worried about overdoing it. Okay, so the Fed meeting minutes, they're released 3 weeks after the meeting, so there's a huge time delay between what happened at the meeting and what happened by the time the minutes released. And what we've seen since then, obviously when the SEPs were released, they had this huge influence on the bond market. We saw bond prices fall down to like decade-long lows, and bond yields climb and soar up to decade-long highs. And that is an enormous economic development, not just a market development, because bond yields are used as benchmarks for financing rates in the economy. So when bond yields are going up, that also contributes to financial conditions tightening, at least in theory. So when at the meeting, the Fed released the SEPs, so the projections, that caused the bond sell-off, at least partially. And now we're in a position where 3 weeks later, the Fed says, but we might need to tighten one more time. And markets just are not buying it. It's one of these really funny things that traders have been looking at this whole year. This whole year, the Fed has been saying to markets, we are staying hawkish. And markets are like, that's cool, but no. All right. And so I'm just going to take you across to my screen here and show you the swaps market on what markets are pricing in for Fed expectations. Okay, so just read this explicitly on this minutes. I'm going to put it up for you again. This first sentence. As in the SEPs showed, FOMC members, the majority of them predict one more rate hike this year. The minutes state one more rate hike this year. Okay, it's crystal clear. It's objectively, the Fed couldn't be more clear in its signaling here, right? Here's what's happening on the swaps market. Here's how markets are pricing in Fed expectations. So this is the CME Fed Watch tool, which basically gauges investor sentiment towards Fed expectations. So the current Fed's fund rate is at 5.5%. So this is the upper bound here. This is shown in BPS, basis points. 525 to 550, so 5.5% upper bound, okay? And as I just said, the Fed has signaled in its SEPs, in its minutes, that they see one more rate hike this year. Or maybe not this year, but in the cycle, they see one more rate hike coming. And here's how markets are reacting. 94% chance no rate hike at the next meeting in November. 70% chance no rate hike in its December meeting. 70% chance still at 5.5% in January. And then after foreseeable, 60% chance it's still at 5.5%. So basically, markets don't believe the Fed that there's another rate hike coming. They don't see it, at least the majority don't. So that the market is currently not pricing another Fed hike coming. Alright, so we have this situation brewing where markets again just don't believe the Fed. They're saying, nah, the Fed ain't going to do what it's going to say it's going to do. So we'll see. We'll see how that develops. But what you need to understand is that markets aren't dominantly pricing in more Fed hikes. Alright, so that's what we had up until Wednesday. We had that geopolitical instability. We had that dovish Fedspeak. Then we had the hot PPI readings. And then the Fed minutes. Thursday morning here in the UK at 7 a.m. we had the UK GDP readings, which showed that came in basically in line with expectations. And this is quite significant because the fear in the UK, as I've said in many videos in the past, is the recession risk. And so just to show you the 3-month rolling average of UK GDP, here's what we're seeing. So you can clearly see it's not a strong trend, but it's definitely in the positive. It's in the green, if not by a hairline margin. It's still there. But moving on to the big news that came out on Thursday was this US CPI reading. And this is probably one of the biggest data points we get every single month, particularly in the current monetary situation we're in. And it was a little bit uncomfortable, and it was mixed data. Core readings came in low as expected, continuing the downtrend in core, which is fantastic news for the Fed. But alarmingly, there was some stickiness, there was some hotness in the headline CPI readings. So I'm going to take you across to my charts and show you what we saw on Thursday afternoon or early Thursday morning in the US. Okay, so here is the data as it came through on Trading Economics. Here are the core readings we had. So the core readings came in basically bang on forecast. 0.3% expected on the month-on-month. That's holding steady. Ticking up a little bit from last month. Okay. But the year-on-year figure, here's what we're looking at. Boom, straight down. Okay, and this is good. This is good news for the Fed outlook, because it's core inflation, of course, that the Fed can target best. So to see that coming down is good news. But the question is, of course, is it coming down fast enough, and will it continue its descent? Okay, so this month-on-month figure we saw slightly ticking up a bit. This is quite alarming. This isn't good news. You want to see core inflation decreasing. The month-on-month figures decreasing is what you want to see, as with these year-on-year readings. You want to see core inflation continue coming down. Right, so as the Fed's monetary tightening kicks in, you should see this core inflation coming down. So what we're seeing on the year-on-year reading, that's okay. This 0.3 tick up is slightly alarming. Okay, that's something to watch, definitely. The big news, of course, was the headline CPI readings, both month-on-month and year-on-year, coming in hotter than forecast. And that shocked things a bit later on in the week, as we'll get to. But just to show you what that looks like, here's the headline year-on-year figure. Okay, CPI this is. It's a consumer price index. This is demand-side inflation in the macroeconomy. We saw it coming down all year till we had that brilliant 3% reading, which was released in July. It was for June. And since then, we've seen the readings tick up. And this reading we had on Thursday was supposed to come in, as economists predicted at the very least, at 3.6%, and instead it stayed elevated at 3.7%. So there wasn't a decline in headline inflation as compared to the previous month on the year-on-year reading. Okay, so this shows a little bit of stickiness coming in on headline CPI. This isn't what the Fed wants to see. This is not good news for the monetary policy outlook of the Fed. If headline stays hot, the Fed has no choice but to stay hawkish. All right. So this is the data we had in terms of inflation at 1:30 p.m. UK time on Thursday. We also had the initial jobless claims. Here's how that came in, excuse me. And this is what we've seen all year. So this is a 12-month chart. You can see every reading from the last 12 months. And as you can see, the reading we had this week, so this is initial jobless claims. This is an early indicator on sort of labor market strength or weakness. Jobless claims are staying quite low, lower than they have been for most of this year, which indicates labor market strength in the US. Okay? If initial jobless claims stay low, that means there's less people claiming jobless in America. This means stronger labor market. Okay, so that's the data we had on Thursday. But again, the big news that came out on Friday had to do with America, okay? And we had the preliminary reading, so the first reading of the University of Michigan's consumer sentiment, which is possibly one of the most important consumer sentiment readings in America. Gives us the best indicator as early as possible, particularly in the preliminary reading, as investors, as people looking at markets, as people looking at the US economy. Okay, what are consumers, so people who buy things in the economy, how are they feeling about the economy? If they're feeling good, they're usually out there spending more money, stimulating growth, causing more stonks to go up. How was it doing? And the reading came in very, very low, right? The reading came in significantly below expectations. This was definitely a shock reading on the back of the Fed hawkishness and bullishness we've seen over the last few weeks. University of Michigan's consumer sentiment figure came in at 63 as compared to around 68 expected. Okay, so this is a huge drop off. All right, this is a huge drop off in consumer sentiment, which begs the question, one, why? Probably something to do with the soaring bond yields. Two, it begs the question, what does this mean for the US economy? If consumers aren't feeling so good, if they're not going to be out being so bullish in the economy, this obviously has a knock-on effect. So this reading coming in very, very low begs the question, what does this mean for the US economy? Is this bit of a shock reading that we saw, or is this the part of a broader trend down in consumer sentiment? Right, we shall see over the coming months. But this tick down to 63 is a big deal, because if the consumers aren't out there spending money, that means there's going to be less growth, which is obviously great news for inflation. But the double-edged sword, not so great for growth. So that's definitely something to look for next week, to see if this consumer sentiment trend going down we've seen the last few months, does this continue, or is this just a bit of a shock reading? That was just to bring you up to speed on the developments that happened this week. We had that geopolitical instability, we had the Dovish Fedspeak, we had these really not great inflation readings, the PPI, the headline CPI. We also had the Fed minutes, and then we had the University of Michigan's consumer sentiment reading show weakness in consumer sentiment, okay? So that was just to bring you up to speed on the behind the scenes development. What was driving markets this week? That's what happened. Now what I'm going to do is take you across to my charts and show you the price action in markets in the week and explain when what was happening, why it was having the effect it did, so that you can understand why markets behaved the way they did this week. Okay, so to start with here, we're going to analyze how US equities, so this is stocks, the US stock market, how they reacted to all of these events that happened this week. And you can clearly see here in the beginning of the week, we had stock indices climbing, right? A very, very clear up move here. And this was on the back of this dovish Fed speak we had at the beginning of the week, where Fed speakers were saying, hey, we might be done with financial tightening, right? Which is great news for the economy. It's great news for the stock market, because it means companies are free to make more stonks, essentially, right? So this is the S&P 500. Up at the beginning of the week, and then you see it just hits a bit of a malaise here. And of course, what's happening in the middle of the week here, guys? What did we talk about? You had this PPI reading come in on Wednesday showing hotness. So strong inflation coming in midweek on that PPI reading showing stickiness. You had the Fed minutes saying, yep, we're gonna have one more rate hike. So markets are like, optimistic at the beginning of the week, driven down a little bit by the end, or midweek, I should say. And of course, then you also had the fears of geopolitical instability spreading to stocks around this part of the week. So people were wondering, okay, is this going to fall out into a world war? Big news that happened on Thursday. What was it, guys? It was, of course, this CPI reading coming in showing sticky headline inflation. So high inflation, bad for stocks. It's basically the very, very simple equation you could use at the moment. And then on Friday, we had this sell-off back down when that University of Michigan report came in. Okay? So here's Friday, boom, back down we go. So investors were optimistic at the beginning of the week. That PPI reading comes in, those Fed minutes come in, the hot CPI reading comes in, the University of Michigan reading comes in, and boom, back down we go. Okay, so this is the behavior On the S&P 500, you see the Nasdaq follows pretty much the same pattern. Up at the beginning of the week, down towards the end. Okay? And it's very, very simply due to these fundamental drivers in the economy. Moving on to bonds. Bond trading was closed on Monday for the Columbus Day holiday in America. And here's how bond yields reacted. This huge drop off. So starting close towards 5% in the 30-year here. And then you just see these yields drop down to, well, below 4.7 here. Again, guys, if you're new to trading, if you're new to investing, these are huge moves. The US Treasury market is usually very, very solid, very stable. A drop of nearly 3% is absolutely enormous on long bonds. Okay? This drop off is severe, and this is on the back again of that Fed dovishness we saw at the beginning of the week. Alongside the geopolitical instability, people are buying bonds, so the yields go down. Then, of course, here we see that boom. The shock back up is that CPI reading coming in. Markets really didn't like that. Pushes yields back up because it means the Fed is more likely to stay hawkish. All right, so that and this is broadly, basically exactly what happened. You can see all down the yield curve here. All of these bonds are following the same pattern, down at the beginning of the week, up towards the end. Again, it's all on the back of these dovish Fedspeak at the beginning, hot CPI reading at the end. So to move on to currencies, you can see here the US dollar had a little bit of a bump at the beginning whilst people were moving their money into America, buying gold in US dollars, buying US treasuries as they were worrying about World War III. This pushes the demand for the dollar up. So we saw a little bit of a bump up here, and then the US focused fundamentals took over, and that dovish Fedspeak just pushed the price of the dollar right back down. Until, of course, that big CPI reading we had on Thursday, which showed headline, again, coming in strong. Boom, back up the dollar goes. Okay? And so we're seeing FX and bonds and stocks really take notice of the same fundamentals here, right? Geopolitical risk, the inflation outlook, the dovish Fedspeak. All of these markets are worried about the same thing right now. Okay? And to take you across to the commodities market now, we saw some absolutely enormous moves in the gold futures. That's nearly a $100 move in the price of gold in 5 trading sessions, okay? This, again, is an absolutely enormous spike in gold. If you like this video, please know I post debriefs every single Saturday that explain market events and explain why they have the influence they do, just like I did in this video. Alongside videos every single Sunday explaining what to look for in the week ahead in markets. If that sounds like something you would find useful, please consider subscribing, and good luck.